Well, our top story at this hour is tied to the Bank of Canada. Lots going on for the central bank to digest, whether it's the trade uncertainty or some sticky inflation. But while the Bank of Canada left its key interest rates at their current levels, 2.75%, Bank of Canada Governor Tiff Macklem leaving the door open for the possibility of more cuts in the not-too-distant future. Dominique Lapointe is a global macro strategist at Manulife Investment Management and joins us with some reaction. What did you make of what the Bank of Canada had to say?
So there's three things I think from the statement. The first is that to the bank, trade uncertainty is still very high. And so in that context, it's very difficult for them to do any forward guidance on where interest rates are heading next. The second is that they assess that growth is fairly weak, the momentum in the Canadian economy, with a drop of 2.5% of real GDP growth. That's lower than where the consensus is now. But they attribute that to a pullback from the inventory front loading at the beginning of this year. And they also think that the weakness we see in the Canadian economy so far is mostly sectoral, not broad-based. And that's important for how they have to react to it. And the third element that is important from this morning is that they think that inflation, the underlying inflation pace is at 2.5%. And that's significantly above consensus and above their target. And in that context, it's difficult for them to allude to imminent rate cuts if they're not sure if that inflation rate will decline in the near future.
And I wonder, if coming into this meeting, it felt like the broader tone on Bay Street was that, the BoC, it's possible, might not cut rates again for all of 2025. And to sort of put some messaging out there that would very clearly leave the door open for more rate cuts. What do you think Tiff Macklem is ultimately trying to achieve with respect to market views right now?
So that's an interesting element because, to your point, we were not expecting that the door would be left open to more rate cuts explicitly in the statement. So that tells us that they think that, for instance, the negative output gap that is currently in the Canadian economy, that got worse since January with the trade war, will put at some point downward pressure on core inflation. And what we saw since the beginning of the year in terms of stronger inflationary momentum, either from counter tariffs having an impact on core goods, or perhaps past wage increases being passed through services inflation, that will roll over. But they want to see, we think, a couple of data points from CPI that tell them that this is the right direction, this is the right forecast, and then they're going to be in a position where they can cut rates once or twice. Also have to keep in mind that two more cuts, for instance, one at the end of the year, one at the end of the beginning of next year, for them will only bring the policy rate at the bottom of their neutral range. So for them, they're not even stimulating the economy if they cut twice more.
Now, in terms of the loonie, there was also some consideration in this decision around what's been happening with our currency, and namely the appreciation of the Canadian dollar, and what that means for a variety of things, including import costs. Obviously, we'll get more clarity from Tiff Macklem on how he's thinking about the currency when he has a press conference in less than a half hour's time at this point. But how should we interpret the Bank of Canada's assessment of the currency factor?
So within its own range, the Canadian dollar has been a little bit volatile this year, with first some depreciation, right, after the November election, and then some material appreciation. So if within their assessment, they're thinking that at the beginning of this year, the lower Canadian dollar had an impact on, say, food price inflation or other items imported, then they should expect also a pullback after from a stronger Canadian dollar. So you cannot really make monetary policy decision based on their short-term movement in the Canadian dollar. I think what they project is an unchanged currency. And also what we think is that the movement in the Canadian dollar has been mostly explained by how the broad-based U.S. dollar did versus, say, the euro and the yen since the beginning of this year, and that's almost independent from where the monetary policy in Canada is doing. What will be interesting, though, is what the Fed will do next year, starting in the middle of next year, and how markets might price in or not additional Fed cuts versus very little more in terms of cut from the BoC. That could be a driver of the currency going into next year.
Well, and we're almost out of time, but I'm glad you brought up the Fed because they're next up today. They have a decision on rates this afternoon. And I would say that it feels like the conversation on Wall Street this morning has been that they will not be laying the groundwork for some imminent rate cut. But nevertheless, even if you look under the hood at some of the GDP data this morning, while the market response seemed to be, one that says, oh, is a resilient U.S. economy here, there were some factors you could look at in that data that would suggest that there is some weakening in the U.S. economy that might actually warrant the Fed at some point cutting rates. So how does Jay Powell message to the market, do you think, compared to this, Bank of Canada decision today?
They don't face the same kind of economic weakness. So you're right that when we look at GDP, final domestic sales, slowed down in Q1, slowed down even more in Q2. But the unemployment rate is still at 4.1%. So for the side of the committee that wants to see lower rates and prevent the unemployment rate from rising further, they will still think that we should lay the ground for a September cut. And Powell is probably slightly in that camp. However, we have to remind us there's another event to do so at the Jackson Hole meeting. So perhaps that meeting will be more or less the same that we've had last time. And having another month of data will really set the tone for additional cuts this fall.